Okay, we're ready to start week 6. And with week 6, we start with itemized deductions. That it's located on the 1040 on the back side of the 1040. It's a after the line or below the line deduction. Still a deduction, not a credit yet. We're going to talk about credits next week. Also next week I will discuss what to expect for the midterm and kind of the ins and outs about what's all going to happen. You'll have a proctor form sent out. I'll send them out this week. And then by next you'll be able to take it over about a 2-week period if you so choose to take it early. So this week we're going to jump in here. I've got pulled up the session 6, standard deduction versus itemized deduction. Again, you pick one or the other, whichever one is more beneficial to you. Most people, it's much better to take the standard deduction. A lot less work, a lot less paperwork. But sometimes the itemized deduction comes into play, especially for those who own a home, and even more so if you own a home and you're single, because you can deduct mortgage interest, which is one of the few interest items you're allowed to deduct. There's student loan interest that you're allowed to deduct, and you're allowed to deduct mortgage interest, about the only 2 interests that you're allowed to use. Any other type of interest, like car loan, credit card interest, you're not allowed to deduct those. So going here to the assignments and assessments, the normal homework chapter 5, the end of the chapter return questions for chapter 5 are going to be very similar to what they were this past week with chapter 3 and chapter 4, except this week we'll only have 1. We're going to do this the Sanders return, number 3 here, and then we'll have 2 shoebox examples like we did for chapters 3 and chapter 4. But instead of having the chapter, the chow one, we're going to have, and I'm going to pause real quick. I'll be right. Okay, quick little pause there, but we're back. So again, we're going to do the shoebox tax problems. The chapter 5 Ramirez kind of goes in pieces along as you go through the book. You're going to see medical examples, some interest, and then some real estate taxes. I can't remember all of the sections. Some miscellaneous itemized deductions. And then it kind of puts it all together in one big one here with this new person that we haven't done yet, the master's return. So with the Ramirez, you're going to pick up where you left off with chapter 4. Continue on with that tax return. There is no chow example for this chapter. Instead, they use a new guy or girl masters to show a complete itemized example. I am offering some tax return extra credit in the back of the book. The comprehensive problem number 2, Appendix B. I will most likely have this set up like I do the end of the chapter questions. Well, and so you'll fill in the answer key instead of actually submitting a tax problem, since the answers, of course, aren't there like they are for the shoebox problem. I'll most likely have that set up by today, Monday, this afternoon, the 16th of February. Okay, let's dig in now to the itemized deductions. Just pull it up. All right. We're going to start the first schedule of the different schedules that are available for the 1040. A schedule is a pretty big area within the 1040 that needs some extra discussion, that needs some extra work shown. A lot of these schedules are pretty intensive, pretty big. The only one that's not very complicated is the Schedule B. The Schedule B only, as I put here, it only lists if you have interest coming in, interest income or dividend income of $1,500 or more, you need to specifically list who it comes from and how much. And that's pretty much all there is for the Schedule B. It's pretty simple, but the rest of these are a lot more complex. We actually spend 2 weeks just on the Schedule C, We spend a week on Schedule D, and then a week on Schedule E as well, and then a week on Schedule A. They are pretty big. Schedule A, the first one, Itemized Deductions. The first thing that I should point out, though, is most people don't even qualify for the Itemized Deductions. It would hurt them if they did that instead of the standard deduction. Some people call this, I have a lot of older people come in for VITA, for the voluntary income tax systems, and they say, oh, I don't need to file long form. Well, what they call long form is meaning they're having to do itemized deductions. And that's correct. They would need to file the long form or itemized deductions. The standard deduction is just the government allowing you to take personal expenses because you have to live on it and not being taxed on it. So they're taking a set dollar amount away from your income. So if you're married filing joint or the surviving spouse, you get $12,400 off of your income, which is $12,400 is just double the single amount, which would make sense for a married filing couple. Head of household, remember to be head of household, there are certain requirements. You have to have a dependent, and a dependent generally will have to live with you except if it's a parent. And in that case, you get to take about somewhere in the middle here, $9,100 off of your income, which definitely helps. You're not paying as much in taxes. So the different items that are used for itemized deductions, these are things you'll just kind of want to have memorized. The medical, the state and local taxes, including real estate, the mortgage area, and charity is another bigger area. The last two aren't used all that much. The medical is another one that's not used all that much, and you'll see why. For a lot of people who have, if they have flexible spending account or a health savings account through their work generally, any items you take that pay out of your flexible spending or your health savings account, you can't use towards medical expenses because those expenses were already excluded from your income. So like if you had a W-2 and on box 1 it said $50,000, but you know that you really earned $54,000, that's showing that you had some money that you earned that's not even taxed because it went right in to pay for your medical expenses like health savings or your flexible spending account. And then for anybody else who pays for their medical expenses out of pocket, you're going to have quite a bit of medical expenses before even the first dollar can be counted as an itemized deduction. So who you're allowed to claim as medical expenses, you can read through here. Mainly it's just for you and your spouse and dependents, except for a couple exceptions here. You can read through that for as you're going through. And as I mentioned, this is the key, a big one here, that some people try to claim these and they don't know that they can, but it would be considered double dipping. You're not only being taxed on it up front, but then you're trying to take more money off of your taxable income by showing you spent medical expenses. But again, if it's with a flexible spending or a health savings account, you can't do that. And I give a little example here just to show you right off the bat that most of the time people bring in even quite a bit of medical expenses. Say they pay $3,500 out of pocket for a good bit of things that went on during the year, and they're going to see that most of that, if not all of it, isn't even allowed to be included. You have to have over 10% of your AGI in medical expenses before the even first dollar is counted. 10% is a huge number to climb over, and I hope most of the people don't have that. That would be, so for example, if you had an AGI of $40,000 and you spent a whopping $5,000 on medical expenses, you would only be able to claim, as I can pull up here, after 10%, you take away 4,000. 10% of 40,000 is 4,000. Take 4,000 away from this, you would only be able to include 1,000 of the 5,000 on your Schedule A, which 1,000 isn't going to do a whole lot unless you have a bunch of other expenses to add on to that. especially if you're married filing joint and you've got to get over that 12,400 number before itemized even makes sense. Again, you want your itemized deductions to be, if you're married, over 12,400. Again, it's quite a bit less if you're single, to 6,200. And so here I said very little, if any, can be used. Qualifying medical expenses, your prescriptions are definitely allowed. Any payments you make to a doctor or a hospital for surgeries are allowed. Dental is allowed. Only a couple items of cosmetic surgery are allowed if they are correcting one of these 3 items. If it's just general cosmetic surgery, that's not considered a qualifying medical expense for deduction. You see here nursing home expenses, this would probably be one of the times where it wouldn't be too hard to go over that 10%, because nursing home expenses can be quite high. And they have to be for medical care, so you can't just have somebody in the nursing home because they're old and it's very hard to take care of them. So as long as there's medical care going on, which I think would be the case for most individuals, then it would be allowed. Long-term care premiums. So if you're paying for health, for just long-term care premiums, basically is what it's called, similar to health premiums, there is an amount that you're allowed to deduct depending on your age, and you'll have to. It changes every year, so I just go ahead and have you look at it in the book, and you can see there's one multiple choice question that concerns this in the homework. Things that definitely are not allowed, and excuse me, one quick pause here, and I'll be right back. Not that you really care, but the reason I'm having to pause is it's really dry, of course, here in the winter, and I have the capillaries in my nose get really sensitive, and I get bloody noses all the time. I felt some coming down, so I needed to quick stop that. So if I do need to pause again, that's why I'm trying to make sure I get that under control. All right, so one of the biggest items here that is not allowed is over-the-counter drugs, buying things in the general cosmetic surgery. It's not allowed. You can read through the capital expenditures. That is pretty, of course, as you can imagine, a pretty rare item. The medical transportation, if you do have a lot of trips, this could begin to benefit you. The 23.5 cents per mile, especially if you have to drive a long distance, say to like a Mayo Clinic or something. That would be something that you may want to begin to look at. The second part of the, and what I would highly recommend, I forgot to mention this, as we're going through, I think it's very important to get a visualization of what we're talking about. And so I would highly recommend you to, as we're going through each section, to look at page 5-2 of your book. And look at a Schedule A as we hit each item. And you'll be able to see this in more detail when you do a tax return as well. And looking how you can kind of break down some of these different areas and expand them out just a little bit. So our second section here is the taxes that you pay. Most of the time, especially for those here in Indiana, on that first line, on line 5, we're going to use the income tax that was withheld from your check. So at the bottom of your W-2 in lines, in the boxes 16, 17, 18, and 19, the ones in 17 and 19 are going to show how much money was for state and local was taken out of your paycheck. That amount you can use towards your itemized deduction for a state tax being paid. And the W-2s will transfer that right over to the to line 5 here at the Schedule A, assuming you put it in correctly. So you won't need to put that in twice. It's going to be one that's, depending on your income, could be quite high. Another one that's going to help you possibly get over the hurdle to use itemized deductions. And then as you can see, the next line here is the real estate taxes. So if you own your own home, you can put down real estate taxes depending on how how big your property is and how much it's valued at will be a big determinant on how much real estate tax you get to deduct. Personal property taxes, if you pay property taxes, say on your boat, on your car, you can deduct these. If you just have a couple cars and you don't have really a mortgage interest or anything other big, those smaller items, even though they don't seem small when you're paying them, they don't really add up all that fast to get over that hurdle. So if you don't have too many items, it's probably not going to make a difference. But you'll find the property taxes on your registration slip for your car or your boat. You cannot count, though, any fees like the wheel tax. That doesn't count. It has to be a tax based on the value of your property, not a standard tax that everybody has to pay, like the standard wheel $25 tax that is in Indiana. You can't include that in your personal property taxes. One thing that some people get confused on is back looking at the 1040, line 10, is the state income tax refund. If you receive a refund from the state of Indiana, or any state for that matter, it's not going to be taxable unless you itemized the prior year. If you itemized, then that amount most likely would be taxable. There are a few instances where it may not be, depending, and the software can help you figure that out as you're going through. You put in how much did you itemize last year, how much of that was tax-related, state tax-related, and then it'll tell you how much is actually taxable of the refund you got from your state tax return. We will have a couple examples of that. I don't know if it's, I can't remember if it's this chapter or not, where there will be an item where it's, you did itemize and you did itemize the year past, and then it'll say you got a state refund, state tax refund last year, and then that amount will be taxable, and you'll need to go through the steps and make sure that, go back when you're done, did it actually end up on line 10 of the 1040? If you didn't see anything on the line 10 of the 1040 after you input it, you probably did something wrong. So for the few states that don't have income tax, those states would be able to use a sales tax deduction, so whatever they paid in sales taxes for the year would be able to be as a deduction. The IRS actually has a kind of like the income, where it shows how much you need your tax liability based on your income. They have a similar chart for sales tax. Depending on your income, your family household number, it'll say you probably spent about this much in sales tax, and you can use that number. Or if you choose, you can collect all of your sales tax for the year, which would be kind of a pain and a lot to add up at the end, but you would have that option. One thing you cannot do is if you, say, live in Indiana, and you can choose the sales tax if you want. It's usually not as good of an option. But you cannot do both. You cannot say, I bought a new car, and so I'm going to add in the sales tax on that car for this year, and then also do my state income tax dollar amount. You can't combine them. So if you just bought a new car, then you would need to use the sales tax method for you that year. Real estate taxes, we talked about. Property taxes, we talked about. Interest. I mentioned this as well. The big thing is if you're going to itemize, you will probably have a mortgage. Most people, if they itemize, will have a mortgage, because this is the biggest one typically on your itemized deductions that puts you over the limit. Notice there are two ways that you can have a mortgage. You can have it on your qualified residence. You can also have it on a home equity loan, where it's kind of like your second mortgage. There are some dollar limits. I'm not huge on those dollar limits, but I do have a couple examples down here to make sure you understand them. For those, if you ever do taxes in real life, for people with big homes, have big mortgages over $1 million, or second mortgages over $100,000, then some issues come into play where they can't take as much of their interest that they had. So notice you're allowed interest on the first $1 million. So even if you have a home that has a mortgage of $3 million, you can still take the interest deduction. You just can't take it all, how much you had. So say you had a $3 million mortgage and you paid $30,000 in interest that year. You would only be able to take, since $1 million over $3 million, the cap is 1. You had 3. You could take a third. You could take a third then of your $30,000 interest. You would be able to deduct $10,000 interest as a Schedule A mortgage interest deduction. Same issue here with the $100,000 item. You can go through these on your own with the answers that I've provided. So definitely do that to see how that works. But I think my little explanation here should do it. Mortgage premiums, PMIs, what they're mainly known as, mortgage insurance payments. You can deduct these. These are if you have paid down less than 20% on your home. You will have PMI as well, extra payments that you have to make with your mortgage, and those are allowed as a deduction for this year. Let's continue to go down. Charity. You are allowed to deduct if you give to a qualified charity. Notice that is a actual charity. Just giving to a homeless person does not count, or giving money away to any other friend does not count. You are allowed to deduct your cash contributions. However, the IRS has really cracked down on that in the last year or two. You better have a receipt for everything that you have donated and signed and shown on their letterhead for that company. They get more, the IRS gets even more stringent the higher the dollar amount. So it's good to have a very detailed record of everything that you have done for charity. The IRS has cracked down and they're reviewing a lot of those returns and auditing those. Typically, you're allowed to deduct up to 50% of your AGI as charity. I don't know very many people that have that option or ability to donate up to half of their AGI, at least people that I work with. Usually you have to use most of your money for yourself. So this doesn't really come into play except for some high-income individuals or those who received a large inheritance. Potentially could have this be a factor, but again, that's a pretty rare instance for the type of individuals that I work with. Read through the rest of this. The unique painting, the unique property issues. I did want to discuss this. Notice if you donate your unique item to a place that's actually going to use it for the purpose of what it's there for, like art in my example here, and you put it to a museum that's out on display, that would be a related purpose, and you would be allowed to deduct the fair market value of that item. However, if you donate, in my example, a painting, and it goes into the principal's office to be used as office decoration, that's not a related purpose for that unique item, and you would only be allowed to deduct the original cost. So that could definitely be an issue, so you may want to think about how you're donating something, especially of a large dollar amount that has went up in value. This last little thing, there is a homework assignment on this, so I wanted to hit it. If you have long-term capital gain property, long-term capital gain means it went up in value since you had originally bought it. A lot of things go down in value, obviously, until they get so old and then they become collectibles and unique, like maybe a coin collection. If it is a long-term gain property, if you would have sold it and you would have typically had a gain on it, you bought it for $500 and now it's worth $2,000, you would have had a gain of $1,500. If that's the case, you are limited to 30% of your AGI as an allowed deduction for the year. The rest can be carried forward. So there is an example in the homework that does touch on this. So if the property did go up in value, you're only limited to 30% for that year. The rest of it can go forward into the future years. have some examples that I think would be good for you to go through as you're looking through this for this chapter. Okay, there is one problem as well for the homework that deals with casualty losses. This is a small little section in the itemized deduction, but it's there nonetheless. Casualty loss has to be, and I have it in nice big bold here, one of these three things, if not all of them. It can't be something that you anticipated or that happens all the time. Sudden, unexpected, or unusual in nature is a casualty loss. If it's not one of those, it doesn't count. And it's got to be that way for an unusual for that area. So you could get into a real battle, possibly with the IRS, if you had hurricane damage down on the Gulf Coast. Because is it unusual for that area? I don't know how that would be necessarily. It's probably been handled. We'd have to look through some court cases and see how that's been looked at. But I could see it going possibly either way. Hold on. Let me stop here for a second. Okay, so the first thing you always have to do is, if you did have some damaged property, is you got to take the lesser of the fair market value or the basis of the property. And there is a case in the book that definitely deals with this. So, and this is for individual items, not as a collective whole. So the fair market value or the basis of the property. Subtract out any reimbursement that you got from the insurance. And then the two items that you need to do is $100 per event. Subtract out. They just require you that you have to do this. And that's per event, not per item. And then the amount has to be like medical, has to be over 10% of your AGI, which is going to take out most people from even being able to take this deduction. Some items that are generally not allowed. Again, I'm not taking a lot of time on this section because it's not that common for most people. Filing is more of a rare event. But termites typically has not been allowed in court cases because that is a slow damage, even though you may have not found out until it was almost done. These are items that, again, have gone through court cases and typically been denied. Miscellaneous, the last item, the last section of the Schedule A. Expenses, first off in this area, if they don't exceed 2%, again, it's another hurdle you got to meet. If they don't meet 2% of your AGI, you can't claim anything. And then some items that fall into this category. Anything in your job that you weren't reimbursed. Say you had to do some traveling for your job and you weren't reimbursed mileage. That could be an issue. For whatever reason, tax prep fees are on here. I think that's kind of an odd one to have all by itself. Job hunting costs, safety budget fees, hobby losses. Mainly what they mean by losses is, maybe I should reword that, but hobby expenses up to your hobby income. And as we'll talk about when, the second half of the semester, between a job and a hobby, you can't take any deductions on hobbies. You can only take them as a miscellaneous itemized deduction. And all of your expenses got to be over 2% before you can take even the first dollar. The last one here, the other miscellaneous, these are not subject to 2% of your AGI. And your one of the biggest items in this area is gambling losses. You cannot net gambling losses with gambling winnings and just put the final amount on your 1040. You have to list your gambling winnings gross on your 1040, the entire dollar amount that you won, and then any other additional losses that you had, you can deduct them as an itemized deduction. So you can only take gambling losses if you are able to itemize for that year. If you can't itemize, then you don't. The gambling losses you don't get. All right, that's puts us at about that 30 to 40 minute mark. So let's we'll stop here. Again, next week I will have a lot more to say about the exam for the midterm.